Welcome back to SaaS Buyers Club. I'm your host, Omeed.
And I'm your co-host, Joe.
And today we're interviewing Ray Drew. Thanks for joining us, Ray.
Happy to be here.
Fantastic. Yeah. Why don't we start off and maybe do an introduction, tell people a little bit about you, who you are, what you work on, and yeah, just let people know what you got going on.
Absolutely. Well, I am an SBA lender. That stands for Small Business Administration. So I provide small businesses with the financing they need to mainly acquire businesses and grow their businesses, buy real estate for their businesses, that sort of thing, up to $5 million for all industries, including SaaS.
Very cool. Awesome. How long have you been doing that?
I've been doing it for 12 years. So since college, I got into it, got very lucky. I was 22, fell right into it, fell in love with it because you really get to see, different types of transactions, different businesses. I mean, I've looked at thousands and thousands of deals, talking business acquisitions over the little over a decade I've been doing it. So I love it, man.
So 12 years ago, how did you get into the SBA game?
12 years ago, I mean, you get into it, you're 22, you don't know much. People will hire me to pick up the phone and dial and try to get business for some of the senior loan officers in the office. And that's what I did. And that's how you cut your teeth. There was days where I made upwards of 100 calls in a day and mostly targeting different potential referral sources, right? So like commercial real estate brokers that were selling real estate, maybe to the local manufacturing business and could refer us the financing. So start doing that. After you call enough people, eventually you get a deal and then you kind of have to figure out what to do with it. And that kind of started my career.
Awesome. Where are you based out of, Ray?
I'm in Florida, down here by Miami.
Cool. And you're also a podcast host, right?
Yeah, I got into podcasting in 2019. I started our industry's first podcast, The Art of SBA Lending. So it's a podcast for other SBA lenders. And we've been going for 4 years there. And that's been an amazing ride. And about a year and a half ago, I tried launching a second podcast. And it was around the same time I was also having my first kid. And, I also have my day job and, this and that. So that one, I managed to crank out 12 episodes. That one was called Story Loans. And I think we might bring it back, but it was fun because I was interviewing small business owners on that one versus small business lenders on the Art of SBA. So I was able to tell their stories, and it was all people who had gone through the SBA loan process to buy a business.
That's cool. That's cool. That's something that would be definitely of interest to our viewers and a lot of our current clients who do SBA loans. So I get a good picture of what you've been doing in the past. And so right now, why don't you highlight a little bit about, what your main workflow is? And I know we talked a little bit about this before we hit record.
Yeah, so my core right now is finding small business owners or aspiring small business owners that want to buy a business and need SBA financing, which is the primary financing vehicle for these types of transactions. And then that's, some days that's the easy part, navigating through the landmines of SBA, especially today, where it's, as of about 45 days ago, at the time we're recording this, the SBA rolled out sweeping changes with really good intent about making the program easier, to access capital. And, it's a job creation program at its heart. So they have a mission. They want to get more small loans out there, more minority loans out there, and just more lending in general. And it's been a rocky rollout. So the SBA has always been a tricky, field of landmines to navigate through, but it's been extra tricky lately. So a lot of my expertise and what I'm doing on a daily basis is just helping the small business owners navigate through the process. And so that is, that's my core of what I do all day long. And in addition to, my side projects and this and that, like the podcast.
That sounds cool. I do definitely have some follow-up questions for you there about these changes. We've been seeing them and dealing with them with some of our clients. And also just generally about stories and maybe even like key lessons learned that our audience would definitely get value out of regarding the SBA process in general. Before I kind of want to jump into any of that, I had a quick final sort of introductory question, which was, in terms of your day job, your SBA lending practice, do you have any geographical limitations that you'd like to call out?
No, we lend in all 50 states.
Okay, great. Just making that clear.
Yeah.
Omeed, I think I have some cool follow-up questions to kind of jump into it. Is there anything you want to ask before we go in that direction, or do you have a different direction that you want to take this?
No, man, if you got cool questions, let's hear them.
Okay. Yeah, definitely. Well, I think first up is just following up on directly what you just talked about, which was, hey, the SBA has issued some, or some sweeping changes have been issued in relation to the SBA. Why don't you call out the top three ones that have been, let's say, particularly a nuisance or maybe ambiguous or have otherwise caused issues with deal approvals that you've seen recently or that you just feel like are generally issues? Just the top three so we can get a feel for the conversation and maybe we can follow up in more detail from there.
Yeah, absolutely. And first I want to just backtrack on my last answer. So there are geographical limitations, the United States. So the business does have to be in the United States filing US tax returns for at least 1 year, right? Because, people could be listening from all over the world. And especially with businesses that don't have physical locations. So that's the main thing. Now we're lending to folks, they're buying businesses, they're buying SaaS businesses, they're buying e-commerce businesses, they're counting on the SBA. And so now we're running into a couple hiccups here, also some big benefits on the other side. So it's a mixed bag, overall positive. Now you got to understand where we've been before you understand where we are and where we're going. The SBA always has been a program where the SBA is providing a guarantee to a lender. So the lender develops their own program, just like we do at Fundex. We develop our own program using the benefit of an SBA guarantee behind us. They guarantee 75%. So not the whole thing. There's some risk on our part. We hold, 25% of the risk. But because of the different programs between different lenders, small business owners, when they go to the market to get the loan, they're going to experience some different processes, different credit appetites, different ways of structuring, and even some different interpretations of what you would consider the rules. So that's always been the case. When the SBA rolled out the changes this year, they took a few additional steps in that direction that makes the market a little bit less, well, a lot less cookie cutter. So now every SBA loan might be different than the next because they've replaced a lot of key sections of their rules with essentially telling the lender to just do what you do with your conventional lending. So that's going to give the lenders more freedom and flexibility, but a lot of them are also concerned that if they stray too far from what the SBA wants, that they won't honor their guarantee, which happens. And so so that's one of the big key issues is like that ambiguity of what we can do. One other issue that we weren't expecting was the process to obtain an SBA approval historically as a preferred lender, which I am, which most people are. Most banks that really specialize in SBA are preferred lenders. That means they make the decisions in-house. They don't have to send it to the SBA for an additional approval. Well, as of August 1st, 2023, the SBA wanted to take over a little bit more control from the preferred lenders and make an eligibility decision when we enter that information in the system, which historically we enter it in, it spits out the approval. Now they want to actually look at it. They want to take a couple days, and it's some systems errors that are impacting some deals, and there's nothing you can do about them. So some are delayed a couple days or even a week, but then some I'm seeing snag indefinitely. And I have 2 deals right now in closing that are in that, that holding pattern where they're trying to get information to see what's wrong. SBA won't even tell them. And it's becoming an issue because I don't think SBA quite knows what the problem is. I think it's just wasn't ready for prime time. And they, while their intent was good, we're seeing a couple issues with regards to the new system. So that's two. The last thing is, go ahead.
By the way, just on that, I'd like to jump in with a little comment. It sounds like it's not a high probability issue that could arise, but that could definitely be a disaster for people, especially our clients who they're already wary of the timing, right? Everybody's trying to rush to a close. Everybody's got, the seller wants to sell. The seller wants the buyer to close as soon as they can. They don't want to be waiting for any delayed approval processes. And if that were to happen, it could kill the deal right out.
Yeah.
And usually the purchase agreements don't allow a lot of buyer control over that process, the financial approval process. In other words, in your typical purchase agreement, and I'm talking about buying a business here, it'll say, hey, okay, you have a certain amount of time to go get financing. But if you get caught in an indefinite delay, again, it not being the highest of probabilities, then it could push you back that time period, or there may not even be a time period. It might just be up in the air. And then the seller could pull the deal. I mean, sellers definitely do pull deals, and buyers definitely are on the hook for advisory fees and just their time and other expenses lost during that period. So it's a pretty big issue that you're raising there.
Yeah.
Again, and not potentially being the highest probability. Have you seen in regards to that, or have you been advising anybody in regards to anything specific to do as a potential mitigatory measure, such as, from a legal perspective, we would say, hey, try to put something in the purchase agreement in advance that gives the buyers a little bit of protection if something like that were to occur. That's sort of what a lawyer would do. But from your side, have you decided to do anything differently, or have you just been telling people, hey, there's this risk? What are you doing in response to that?
Well, the main, a couple days of delay is not a huge deal, but the stuff that's the indefinite stuff, that's the bigger issue. That was 20% of my loans that I had in closing. And that's a substantial number, but it could just be me. Honestly, I think probably I got hit with some bad luck because I was looking up the SBA approvals because the data is all public. And the first month that this rolled out was August, and the approvals month over month were actually up 5%. So I don't think there was a big, but we don't know how many were submitted and denied, but I'm just thinking probably it's not a big number. So that said, we've changed our process to get to that point where we can figure out earlier that that's an issue, because historically we've done it towards the end because it's literally just an automatic thing. Now it's not so automatic. So we do it right after commitment, which, because we're pretty fast on the front end, by the time we're getting to commitment, that's before you have an executed purchase agreement. So you should be able to find it out before you actually enter into a purchase agreement. You're under LOI, but you're not under a purchase agreement at that point now. So figuring it out early definitely helps.
No, that makes a lot of sense, actually. And so I'm saying, Omeed, were you saying something?
Oh, you can finish. That's okay.
Oh, no, I was just responding back to that. That makes a lot of sense that you made that little change to fix that. Omeed, go ahead.
2 questions. First one, when you say indefinitely, that makes it sound like forever. Can you give some more clarity around the indefinitely? That's the first question. And then the second question is, what's been the holdup? What have you seen the issues be that result in the indefinite kind of stalling of the funds?
Yeah, this is the frustrating part for everyone involved. And I don't want to get too much into the weeds on it, but essentially it's indefinitely because SBA has given us no timeline to even tell us specifically what the issue is. So we're sitting here waiting 3 weeks at this point to find out what the issue is. We're getting an error code. We've never seen this stuff before. It's brand new. And I think it has to do with other PPP and EIDL loans that are in the SBA system. So those are the big loans that everyone got during the pandemic, EIDL and PPP. And if you have some sort of issue, apparently they're flagging it. And I don't think they quite know how to communicate the issue and resolve it. So I think they're trying to figure it out, maybe because we're kind of just waiting for them to tell us. And, you can call, but they're not, this isn't a situation where you could just call the federal government And it's like calling the IRS, right? It's like, it's hard to get answers.
Understood.
That makes a
Understood.
lot of sense. And no, that's cool. It's kind of just an in the trenches little
Yeah.
topic with these recent changes. Please go ahead now. Tell us about this this third issue.
Well, it's not even, I wanted to give you guys
Or
something
subject.
good. I want to give you
Yeah,
something
okay,
good too,
something
you
good.
know?
And good changes are good too. Yeah, go ahead.
And so there, because I mean, there's really not, it's really not that many issues. The issue is kind of like, you know, I talked about the I guess I can't say that word. I talked about the ambiguity.
Ambiguity. I
Got
got you,
it.
bro. I got you.
Thank you. But you know, it's also kind of like we release, you know, the SBA releases guidelines. We communicate that to the market. The SBA comes back and says, here's 20 things that we did. We're saying it's different now. We communicate that to the market. And it's like, and then it's back. Some of the specific guidance is flip-flopped multiple times. And that's of course confusing. So two of the big benefits, and one of them was a flip-flop kind of scenario that's still in the middle of flip-flopping, but two of the big benefits is like the equity injection. So this is a big part, right? When you're buying a business, more flexibility around how seller financing can contribute towards the minimum 10% equity injection requirement to buy a business. And we're embracing that. And that's helping get more access to capital. We love that. And there's really no issues with that. That is a big plus of all this. So we're doing deals where you've got employees of companies now able to buy businesses. And this is what I've always loved, this type of transaction, where owner goes to sell. They've had their number 2 employee there for the last 10 years or whatever. And, you know, they'd be the perfect person to buy it. But as a W-2 employee, it's hard to save hundreds of thousands to put down towards that 10% injection, you know, if it's that type of business. And so now the SBA has opened it up. And honestly, we've embraced it. We're doing these types of deals now where the seller can contribute the 10% equity in the form of a seller note that they just place on standby for 2 years, which is much better than what we've been dealing with lately. It used to be you got to put on standby for 10 years and it could only count towards half. Now could be the whole injection, standby 2 years. But again, every lender is going to have their own interpretation or their own way of using that type of thing. And a lot of lenders are not embracing it. They want cash skin in the game. And I totally understand that. For me, working in a business 5, 10, 15 years, you've got sweat equity. And so I'm on board with those types of transactions. So that's a big one. And then the partial change of ownerships you may have heard of, and we could talk about that. I don't really want to talk about it, but we can. But that's another one where it's like a big change to the program, which people are really confused about.
Mm-hmm. So it's ironic. Yeah, I was going to actually raise the whole equity or basically this 10% down thing as a major change. It's really awesome to see because like there's just a large population of people out there who are trying to be really creative about that 10%, and they were just like, oh, we can do this, we can do that, but instead now they can just use something that's very simple and tried and true to contribute towards that, which is the seller financing. And that's, you know, we've had on our side had to do sort of a lot of these talks about, okay, what are you guys going to do with this 10%? How, you know, can you make it, or what? Maybe they just couldn't really afford the business they wanted to get because they play out the numbers. And this even gives people, like you're saying, also there the ability to buy maybe a little bit of a larger business as opposed to, you know, a $250,000 to $750,000 business. Now it doesn't really matter per se, but as long as they can satisfy the requirements, they can go ahead and get what a lot of people are looking for, which is a $2.5 to $5 million business. And particularly, a lot of our clients are in the first-time acquirer mindset. So that's really cool there that you touched on that. I mean, I do want to. Maybe we could kind of not get into too many details and make the conversation too choppy, but I do want to get into the partial ownership issue because for a lawyer, we call like every change in law an issue, whether it doesn't mean problem, it just means a thing. So that's kind of how I'm using the word there. And this is also an issue that we run into very frequently in our practice. So I think it'd be cool to talk about and relevant to our clients and stuff.
Sure. Well,
But before we talk about it, I actually heard you say that you don't really want to talk about it, and I'm curious about that too.
just
Isn't this because it's too common?
No, just because it's been such a, it's like probably the industry is probably the most split on this issue. And I don't mind talking about it, but I did a poll actually on LinkedIn to the SBA lending community because the whole deal was, I'll give you the backstory. So for years and years, forever, the SBA loan could only be used to fund complete change of ownership transactions, where if you're buying out your partner, the partner has to go to 0, you've got to go to 100. If you're buying a business, you've got to go to 100, seller has to go to 0. Opening the door to partial change of ownerships gives you the opportunity to say, hey, I want to buy 90% of your business. Let the seller keep 10, that type of thing. And we looked at that when it came out and we said, wow, this is going to open up, a lot of potential types of transactions that were never allowed. And then the SBA came out and said, well, the 6-month look back rule is going to apply to these. And what the 6-month look back rule is, basically anyone who's owned 20% or more of the business in the last 6 months personally guarantees the loan. So if you're a seller, initially sellers were exempt and was written like that. But then they came back and they said, actually, there's a statute that we can't override. And so the sellers are going to have to guarantee the loan, even if they stick on for under 20%, because they've owned 20% or more, obviously within the last 6 months, they're selling the business, they own it. So we're like, okay, well, that doesn't make any sense whatsoever. Essentially, partial changes of ownerships are now going to be dead, because no seller's going to personally guarantee a buyer's loan. So then the SBA came out and said, never mind. And so now the lenders, because you've now flip-flopped twice, and so now the lenders are split. And 27% of them are saying you can do it because you originally could do it. So no PG from seller, because you originally can do it. The SOP in black and white says you can do it. The SOP is currently saying you can do it. So why can't you do it? Right. And I'm like in that camp. I'm not going out and saying, let's all do this, because that could change tomorrow. But the other 73% is saying, I would rather be a little bit more cautious, because our trade organization is saying that let's just be more conservative on this one because it's so murky. And so we're saying we can't do it. So that's kind of where we're at today.
Okay.
Is that what makes it the art of SBA? It's because there's so much ambiguity. Is that what it is?
It's always been like that. It's part art, part science. Yeah, that's exactly where the name comes from.
That's cool. So I actually was just on a call with a client, was it yesterday or the day before, where the seller was saying they wanted to retain some holdings, or one of the sellers, it was a few people have equity interest. And kind of there's just this, the conversation has gotten a lot different than before, where it was just a straight up no. And now it's kind of like everybody's befuddled, and the SBA lender in that matter is on that camp of no. So yeah, I mean, I say from a lawyer's perspective, I say it's funny because this is the type of stuff that happens with new legislation or large legislative overhauls. It's kind of just something we're used to, and it sounds like you very much so are used to too, in the case of the SBA regulations. I don't have any follow-up questions on that. I mean, even though it's unclear, how you described it was very clear. Maybe kind of that ponies us up to get into some cool stories about business acquisitions. Omeed and I always like to talk about in our own personal time when we're talking about, okay, what happened in that transaction? What's the post-mortem? How could any issues that arise have been dealt with better? Or how could they have been completely mitigated in a future transaction? And with that, I mean, why don't we kind of start talking about some straight acquisitions here, as opposed to just SBA regulatory stuff? Maybe you could maybe you have some pet peeves. So I have a lot of pet peeves about, oh gosh, the buyer or the seller is doing this again. This is one of those deals. Do you have any pet peeves about large red flags that people should be aware of if they're seeking to buy or sell a business that you have learned over the course of your extensive experience?
I mean, it's a question that has unlimited answers. I do mostly business acquisitions. It's like 80% of what I do. I do partner buyouts and owner occupied commercial real estate as well. And I lend across all industries. So every industry has its own thing. Like when I'm lending in the trades, licensing becomes a big issue, because the SBA has really specific guidelines around, licensing. We're doing more online businesses. This is something that, when I say online, honestly, I'm talking about any business that doesn't have a physical location, really. So this could be an e-commerce business that just has, they utilize 3PL and they don't have their own warehouse, and, everyone's remote. A lot of SaaS businesses, if not like all of them, are remote. And you even have some professional firms that are remote, like an accounting firm can be remote now. For years, SBA lending's been rooted in banking, and bankers, they're old school. You got to go there and kick the tires and, look people in the eye and figure out if they're going to pay you back somehow from that. And, which I always thought was silly, but now, up until COVID, I mean, financing was really tough to get for all those types of businesses, because they'd be like, there's no collateral, is this even a real business? Now, COVID has kind of accelerated that. People realize, okay, well, e-commerce is definitely a thing. SaaS blew up in a, I guess in a good way, valuation wise, in a good way or a bad way, depending on if you're a buyer or a seller. And lenders had to figure it out, because now this thing was here, and it's going to be here to stay. And so, understanding how to underwrite and diligence those types of business was a new thing for me in the last few years. So I'm still learning on that,
Talk to us a little bit about what you've learned in terms of diligencing those businesses on the funding side. Would love to hear like kind of some tips in terms of what you look for, and maybe some things that you've learned and picked up.
I wish I can tell you. There's 100 different things that can go wrong in a business acquisition in general, and a lot of time you find them after closing. I think the key is to set it up right on the front end to minimize that. And I mean, the best way to do it is seller financing is a big part of it, right? Like most of the buyers that I'm dealing with, they insist on having some seller financing, something meaningful. I mean, 10% would be like market from what I see, but the more the better if you're the buyer and the lender, I guess, because they're the ones lending the money. I'm lending the money, so having that commitment from the seller helps. And I think it promotes transparency. I think it basically gets the buyer and the seller on the same page to set up the transaction and the transition for success. And then after, when that transition is occurring in year one, the seller is going to have a financial, stake in the success. So when you buy a business, sometimes something, doesn't go right, and it could be any number of things, but that is a good way to protect yourself, with the seller financing. On the flip side, there's businesses that have physical locations. That's a lot of them. The pitfalls there are the opposite. You now got to deal with a landlord. That's one of the biggest reasons deals blow up in closing lately. These landlords are getting difficult, and you need two things on an SBA loan: a lease and a landlord consent form. The lease should be for the term of the loan, SBA, which is 10 years, although there's definitely exceptions to that if it's a business that isn't a location-specific type of business like a restaurant. But the landlord consent's a little trickier. This is a form that the landlord or that the lender puts in front of the landlord, and they say, hey, agree to these three things, because it's an SBA requirement. The bank has their own form. It's not an SBA form, so every form's different. Landlords also have their own forms. And then most of the time they're getting negotiated anyway. So the end form is a different form anyway, because it's been redlined multiple times. And, you know, at some point, you know, it used to be that the landlord would be happy to have a paying tenant in there, but that's not always the case anymore. They have their own motivations and they don't have a stake in a transaction like a business acquisition, other than just keeping a tenant in place. But they're just seeming less and less motivated to actually play ball and get those things done in a reasonable time frame and with reasonable terms. So that's another pitfall. There's 100 more.
Yeah, I see. How about in specific to SaaS or e-commerce acquisitions? Are there any specific pitfalls? And, you know, again, there being a lot, but just some issues you've seen in your practice, particularly ones that buyers or sellers should be aware of. I know there's so many just up front, but yeah, just, you know, walk us through some examples from your side.
Sure. Well, you know, I think more and more I'm relying on the buyer's experience in the e-commerce space, you know, because I've done loans for folks that are coming from outside of e-commerce and folks that are coming from inside of e-commerce. And I think that experience is important for most buyers to have somewhere on your team, if not you as the sponsor. But as we're underwriting a lot of these e-commerce businesses, you know, as an SBA lender, you look at 3 years of tax returns. So you're looking right now at 2020, 2021, 2022, and then 2023 year to date. And a lot of these businesses had some really just crazy ups and downs over these years. You call it the COVID bump. So digging into that underwriting has been challenging because 2020, the business might have gone up. 2021, it might have sustained. 2022, it might have been cooling off into 2023. So you have businesses that are going up and down every year in revenue, and it's not a predictable trend. So lending on that type of business with a 10-year loan product like the SBA loan, you're relying on a trailing 12 and projections and assumptions to those projections. And so structuring it based on those numbers is key, because most sellers are, you know, unless you can see a clear trend of down, you know, like a trailing 12 that's trending down, like a seller, there's no denying that. But if you're looking at, hey, the business just took off last year and, you know, we have to dig into why that is and is it sustainable? A lot of sellers, if not all of them, are going to say, yes, it's sustainable, because, you know, you got to kind of prove that it's not. And how can you prove that if the numbers are up? So what I'm seeing is, you know, this slight gap in expectations between buyer and seller on price and valuation. And what I'm seeing more and more is that it's being filled with a seller note, and even more so a forgivable seller note. And that's something that I haven't seen that much until recent years.
That's a really interesting solution to that issue. Because you know, very much so it can just result in a difference. And particularly if the seller just has too high of expectations as to what they're going to receive for the purchase of their business. We even, I have one matter right now in that very situation. So yeah, I like your point there about how it is, you know, you're seeing it being resolved for, though. That's definitely something that can be put in people's toolkit to think about if they're in that scenario, as opposed to an outright change in what the SBA lender is going to provide to make up for it with a seller note, and therefore mitigate the issue. I like that, definitely. Let's see.
Yeah, but you got to keep it simple though. Like I saw a seller note the other day, and it was like that type of scenario. It was a new e-commerce business with a subscription model attached. And is a 2-year-old business. They were selling it for $6 million. I'm like, how do I underwrite this? You know, like I couldn't, first of all, because it only cash flowed in the last 6 months. Like the valuation was basically based on 6 months of, P&L. And they structured two seller notes, but one of the seller notes had 9 points under it. So imagine, seller note, and then it's like A, B, C, D, E, F, G of like the terms. And it was wacky. It was like, there was a forgivable component because they were doing about 750K revenue. There was a month they did like 700, 900, 750. It was like the last 3 months. So they structured the seller
Oh,
note.
looks like we have another
a
guest.
special guest.
Yeah, hey. we always bring dogs on the show. Yeah,
That always
so.
makes it fun. Yeah. And so they structured it to where if the revenue went above this, if the revenue hit this level, we're paying this, payment. If it went this level, we're paying this payment. If it went down here, we're paying that payment. And if it stayed down there for 12 months, this loan's forgiven. So there was a lot of complexity to it. And my advice there, honestly, is I think you got to keep it more simple for most of the time. Most of the time, either the buyer or the seller is not in a place to, be receptive to something so complicated, right?
And were they?
In that case, they were. Yeah, it worked in that case. But, a lot of buyers, if they go to most sellers with something like that, it just gets really complicated.
Yeah, no, I love that. I agree with that. So one thing that's going on a lot right now in the community is, I guess it always has been, but maybe just with the internet and stuff become even more prevalent, is sort of all these types of creative financing and terms and what can we do to get this deal over the line. And one of my refrains is always, if you're working too hard to get the deal over the line, then you're probably doing it wrong. It's not rocket science. Everything's is the business performing? Are there issues? Do you have the capital? Do you have the advisors? Like there's a formula. But a
Yeah.
lot of time, we see first time buyers, and God bless them. We support them through this whole process. But they'll come through with, hey, we're going to do this, this, and that. Your example there talked about a note with several terms to it. I'm talking about like 4 different types of financing. They're trying to do all this different stuff. And that's buttressed by a lot of content out there in the internet of like, do everything you possibly can. But again, keeping it simple, it keeps people focused. And sellers aren't, there's definitely a large rejection, a large percentage or a higher percentage of rejection when you're offering something that's off market. So we as legal counsel, we like to participate in negotiations. Indeed, our number one thing is we want to take the lead on all the negotiations from the LOI phase regarding legal terms and financial terms, because that way we can have the driver's seat and make sure everything's done right. And when we're not doing that, things get, like people agree to terms that aren't possible, and the stuff happens. First time buyer, first time seller. So sometimes in those type of transactions, we have to step in and say, hey guys, what you agreed to isn't something we're going to do, but this is the way it needs to go. Or even, it kind of just goes like, hey, we're put in the driver's seat of trying to make that creative financing work, which we're fine with doing. We're not against trying the best possibilities. But, that's always a hard discussion because now you're explaining to somebody something that's off market. It's just atypical. And it's, going to be hard to get over the line. So I think that's a very useful, poignant or whatever note there too. I don't know if it's a sadistic part of me, but part of me wants to hear a horror story or two about, here is a reason that people could learn from as to why a transaction failed. I know we've talked about some good sort of due diligence or general matters now, but maybe you could walk us through, or if you feel comfortable doing so, being a lender, walk us through an anonymous transaction and something, since we're a buyers club, something the buyer did wrong and the buyer should look out for.
Yeah. Let's see. There's a couple for sure. First one that's coming to mind is, just in general in business, in business acquisitions, these are a lot of these businesses. Yeah, I don't know if you want me to focus more on SaaS. I
Either way is okay, since it's acquisitions and SaaS. Yeah.
Yeah, because I mean, the first thing that came to my head was turnover during the transition for employees, and that's a big one. I mean, the number one issue. So the couple things come to mind, and so employee turnover during the transition is one of those things where can really just be really tough. I mean, a lot of times buyers will get through it, but like the employees are what's making the company go. And people like, I feel like sometimes discount that. I mean, there was one where they had 100% turnover in year one. What'd they buy? That was a people business. And a lot of that can come from too much change too fast. Could just come from personality clashes. It could come from the seller not setting up the transaction for success, maybe lying to the staff about selling. It could come from a GM who maybe they thought they were going to buy the business and the seller never approached them. And the buyer never thought to ask, why aren't you buying the business? And so, people are human. And so you get in there and I've seen that happen where, there's just a ton of turnover and there's no one to do the jobs. And that can then trickle into revenue. One was a medical practice and their billing people left. So they couldn't bill. So they had cash flow not coming in as fast. These are real concerns. The other thing is, and this is honestly the number one reason why this, a business acquisition would fail in the first year would be lack of adequate working capital. And if you've been around this space, that's a hot button, working capital. And, you could do another hour on this podcast about talking about working capital, but the key is making sure you have it. And as an SBA lender, we always include some in the loan for that transition period. So there's going to be a little bit of a cash flow deficit usually, in that transition as the cash starts rolling in. But, meanwhile, you have bills to pay day one, and crunching those numbers is key. And it's a little bit more tricky in e-commerce. So there was one that I'm looking at right now that we just undershot it because there were so many different SKUs on the inventory that it looked like they had plenty of inventory, but a lot of the inventory they had was slower moving. And the deal had gotten delayed a little bit for closing, and the seller stopped replenishing some of that inventory that they should have been doing. And the buyer took over and realized sales were down almost immediately. And what you could have done there is a little bit more due diligence on the inventory versus kind of just guessing high level, because they were like, yeah, 20% of this is probably obsolete. It was actually more of a nuance than that. So that was a combination of not enough diligence on the inventory, plus we should have probably given more working capital at closing on that one.
Did they make it through? Were they okay?
We'll see.
Okay.
No, that's definitely a big issue. I like those stories a lot. I think that's really helpful and valid. It's so often that sellers, again, like we see with non online businesses, like brick and mortar businesses, we see a lot of retiree sellers exiting, and they tend to have more of that traditional mindset. And with these sellers, they tend to be a little more hesitant to tell their employees up until close. And I'd go so far as to say that they tend to kind of not be willing to manage the process as it's supposed to be managed, or as is like market practice, which is kind of setting expectations, ensuring people feel comfortable, having great communication, even assigning internally at the seller somebody who's in charge. If you're the owner and you don't have a grasp on that yourself, assigning somebody in charge of making sure everybody's aligned and the plans are ready to be executed for a turnover, as opposed to, again, what I'm trying to put out here, we see a lot of, maybe too much of, which is seller kind of just telling everybody week before closing, at closing, just a little bit of a prayer and a handshake. And you know, they know and respect their employees, and we actually haven't had any problems in recent memory. Or I think I had one transaction several years ago that had a big employee problem. We always pipe on employee stuff, so we haven't had one, but we still do. We're definitely not in the most de-risked universe and relate to that, in the sense of, if a seller says they're not going to tell anybody and the buyer wants to buy the business, you know, it's kind of pull the plug based off this small tail risk or not, and nobody does, and in what we've been dealing with. So it's definitely iffy, particularly because a lot of these smaller businesses, like right now, there's a big crunch on employment and getting people in play, especially if you need somebody who's a specialist in your industry. If you're if you're a construction business or operating some other trade, you know, you're not going to be able to replace 20 people in the same month, you know, depending, I guess, on the city you're in, how big the city is. But there's a lot of issues going around there that I think buyers definitely need to pay attention more to than just the, you know, usually the conversations about the physical assets and the P&L, the performance, and not to that. So that's kind of one of my talking points. So I'm happy you touched on that.
Yep.
I like where we're going with this. Omeed, why don't I throw it over to you to kind of to gauge where we're at and to help guide us along here.
Totally. Ray, I'm gonna throw a question at you, and I'm curious like what your position will be. The hype around acquisitions, is it a yay or is it a nay?
Well, you know, I'm glad you brought that up, because what you're saying earlier with the internet and the gurus and all this stuff, it is kind of becoming a thing, and it's really interesting because, you know, podcasts, people are finding out about this from podcasts and X, we call it now X. And then a lot of people want to get followers, so you kind of, you know, get people excited about business acquisition. So that's where the hype's coming from, right? So the thing is, when you can buy a business for 3 to 4x SDE and leverage it at 90% or higher if you get seller financing, and you do it right, you know, I'm big on having comfortable debt service coverage, but you find a deal, you structure it right, you do it good. It's just amazing how much of a life-changing situation that could be for someone. I mean, if you really think about it, if you have $100,000 to put in to a business and you can buy a business for 1.5 million or something like that, you know, that business is probably making $500,000 a year. You know, you've got the debt, right? You've got to manage the debt, but you could pay off the debt as fast as you want. There's no prepayment penalty. And then there's also growth levers you can pull on the business. If that, you know, I would encourage people to buy businesses that they can grow and add value to. And then the sky's the limit. And so it's amazing. I mean, this is a program that you don't have in many other countries, the SBA 7A loan. So I don't know. I mean, I think the hype for the right person is warranted. Where I don't like it is the hype for people that have no business running a business, have no money, have no experience doing anything, have bad credit. Like, getting those people excited, obviously I'm not for.
Yeah, dude, I share your opinion precisely. I actually have a bone to pick with these people. We work with a lot of them, or I'll say several of them, and you know, I respect them. But the problem is when you have a guy who's never run a business before, or a multi-million-dollar business, or done M&A before, like, there's a reason the partners at the law firms, we charge very reasonable rates, because we're a boutique and we like to fit with our audience, and we enjoy our work, and our lifestyle is a big importance to us. But at big firms that we used to work at, attorneys are charging $2,000 an hour. How do they charge for that? Well, it's an extremely complicated, M&A is extremely complicated area, and a lot of people have no business in it. And so we, like, a big part of our practice is when we deal with first time acquirers, but we're actually moving away from that. because of this very issue. When we do deal with them, we totally Sherpa them, and we call out the risks to them. We say, hey, here's this problem, this problem, this problem. And if they forget about it or if they're not on the ball, we drag their attention straight back to it. We kind of play that watchdog and guide position there on those transactions to bring them through if they're feasible. Of course, not all of them close, not all of them are feasible. But it's just kind of like, again, I have a bone to pick on this subject. Like, it's kind of like I like to tell Omeed a lot. It's like everybody just learned what M&A was. It's like, this isn't new. This is very old school Wall Street stuff, and there's a lot, and people, like, I guess there's the big saying, like, don't do a startup, go do M&A. It's like, okay. There's literally a million things you can do. And that's not a way to look at business or anything. So I don't like that approach either to it. It's kind of like, it's for certain people. I definitely agree with that. And I especially want to say to anybody out there who, and our podcast is definitely more focused on private equity or larger business inspired sellers. But for anybody out there who is a smaller business or first time buyer or seller, I definitely want to say, there's nothing better that you can do than learn, and speak with experts and learn how to be coached by experts and spend a few years learning. And that's what will make success with pretty much anything. But we definitely see a lot of people just having heard a few things which aren't correct, and all of a sudden we're talking to them and we're like, okay, we have to restructure the transaction because they wanted to structure it wrong in the first place and got an agreement on that. I'm pretty frank with how I don't like it, because we're very procedure oriented people, and we toe the market standard very clearly, especially, as you can imagine, as lawyers. Like, there's only so much we can do outside of the market standard because there's another M&A lawyer on the other side. I forget my dogs. There's another M&A lawyer on the other side who, he's going to hold us accountable. He'll yell at me. He'll say, "What the heck are you doing?" if we don't do something, within the process. So, that's my opinion on it. Omeed, that was a cool question. I'll throw it back to you after I was able to unload there on that subject, Omeed.
I mean, I heard you pretty much just agree with Ray, and what I heard Ray say is, the hype is a yay, as long as people take the time to become diligent practitioners. Like, don't listen to a podcast and just go out there and think that, now you've got the chops to acquire a business. Like, spend the time to become like a meaningful practitioner. Is that your point, Ray? Pretty much that's what makes it a yay.
Yeah. I mean, it's get the experience, prepare yourself, all of that, 100%.
Cool. All right, now I got another little fast pitch I'm gonna throw at you. Lawyers, yay or nay?
Oh, this is an easy one. Dramatic pause. Having a good M&A attorney is one of the keys to the success. So if you don't have a good M&A attorney on the transaction, it's a complete mess. I mean, you need buyer and seller counsel that knows what they're doing.
Yeah, totally. Yeah, 100. And that's the line that's the hill that we'll die on too. So, Joe, anything you want to add there, or?
No, well, I mean, yeah, obviously we agree. But one of my pet peeves on that is where people get roped into an attorney who's not an M&A attorney. Yeah, so for our audience who's professionals out there, they know what's going on here. It's a pretty basic thing. It's like everybody knows get an attorney who's a professional in the area. We often see people get like low price non-M&A attorneys kind of just fumbling through a deal, and it's not right. It's kind of like getting like a kidney doctor for your heart problem. It's just totally inappropriate. And so I don't really have anything to add to that, Omeed. I mean,
Cool.
Definitely go on. Yeah, go on.
Yeah, I was gonna say, I think this is, we're pretty warmed up in the conversation, and I think this is a perfect time to actually really hone in on the SaaS industry. So, Ray, heard you say that, you've done some deals in SaaS. Would love to hear, about some of those deals, and we can just start there and kind of whittle the conversation down from there.
Yeah, it's interesting because the appeal behind SaaS, and I'm not like a SaaS expert or anything like that, but the appeal for me, if I'm a buyer, is just I don't want to say it's automated. I'm trying to think of the right words, but like, for example, we're talking about all the employees on these other businesses, and you won't have on many SaaS businesses, it's more employee light. Obviously higher margin. And it's almost, some of the SaaS deals I've seen are there's almost nothing to it in terms of operational risk, to figure out. And so you have sellers that are doing it. I mean, spending 2 to 4 hours a week, or at least that's what they say in the sim, on their business. And, it's borderline. I'm surprised SBA even is doing the deals today. That's my point I'm trying to make, because a SaaS business is going to have a higher valuation, and an SBA, they are trying to maximize their dollars for job creation. So to me, to do a $5-6 million SaaS deal to retain 2 jobs, and maybe they're in another country, it's like, why would the SBA want to do that?
Right.
So it's almost amazing that we can even do that. So you can borrow, readily available funds to buy a company that is, just, it's SaaS, right? So that's kind of cool. And when people from the SaaS space come to me to buy a business, typically they're looking for 3 types of businesses. One would be a SaaS business. Another would be kind of like what I call a quasi SaaS business, where it's like SaaS based, but there is like a more brick and mortar component to it, or some sort of component to it that is extends beyond SaaS. And then 3 would be kind of like a old normal type of business that can just benefit from some SaaS implementation and integration. And we see all 3. One example of a quasi SaaS business that we looked at was like a platform for real estate professionals to go out and build their business. And so you need that human aspect of it, and the real estate professionals in the field, but then there's also the SaaS platform and behind it. So that's kind of like a mix between the 2, which is perfectly fine, for SBA.
Cool. So just to give us like an idea, like 2 questions come up here. The first question is how many SaaS deals have you done this year? That's the first question. Second question is, was there a period of time, like if you did a look back, where maybe, what year was the best one for SaaS deals for you, for example? Just curious.
Closed wise, it's probably just a handful in the last few years, honestly. It might be 1 or 2 a year, so it's nothing crazy. We do, SBA lenders are low volume. I did 44 deals last year, and probably half that this year so far, year to date. We're in September. But the one that's coming to mind was this stuff you wouldn't even think of. It was scheduling software that was sold to a niche type of customer, right? And it's just a 60% margin type of business, and it's pretty standard stuff. I mean, there was nothing to it.
Joe, was there something you wanted to throw in there?
No, I had no comments.
Cool. And like on that SaaS business that you talked about, like talk to us a little bit about, I hear niche customer. Say more. I'm curious about that. That kind of, just piques my curiosity a little bit. What do you mean by niche customer?
Yeah. So I don't want to give away too much, but I will say they have like, their total addressable customer base, like probably 1,000. So, there's 1,000 potential customers, and they were dialed right in there. They were the low cost provider out of like 3, and it was like the best and the cheapest. And and they were in, and it was a great business, very consistent. There was no COVID kind of weird bumps. It was just it was a pretty straightforward deal, honestly.
Yeah, I hear what you mean there. That makes a lot of sense. I feel like we did touch on some good SaaS stuff earlier, just in our general acquisition stuff. Obviously, a lot of the acquisition points still apply to SaaS businesses, maybe not the employee retention issue. I think that's really funny, by the way, what you raised about the SBA's policy, or its let's say the reason it exists, and then applying that to SaaS businesses. Do you think that that might change in the future, where legislative bodies tend to be a little slow on the take? So it's not necessarily that they're all aware of it and are just allowing it to be. It could be the case that that's an issue they haven't really digested or thought of a remedy to yet. What do you think about that?
There's a data point that we collect that is number of jobs created or retained. I don't think they do it in the US specifically on this form. I think it's just in general. So the SBA has the data. They can look up the NAICS code of SaaS businesses and see that we lent $1 billion to this space and we created and retained 4.5 jobs. Like, and if somebody catches wind of that, I'm sure it's going to be like, do we really want to, and the closest thing we have right now to that, because I honestly, I highly doubt SaaS is even 1% of the SBA's portfolio right now.
Right.
But hotels has been the best example historically, because it's hotel, you got to buy the real estate with it. So you might have a $12 million hotel, and there might be 200 employees there, maybe less, but a lot of the value is coming in the real estate. So we're having to fund, millions and millions of dollars for hotels, and relative to the amount of jobs created and retained, it's probably a worse ratio than a manufacturing company, where I'm buying a manufacturing company for $1 million. There's 25 jobs there. You probably get more bang for your buck with something like that. So they caught wind of the hotel industry, and they've got their ears up, but they haven't done anything. They just know about it. And my bigger concern is the program in general, going away, because there's nothing that says it has to stay around forever. It's been around, for the SBA was created in 1953, and the 7A program's been around for over half a century. And it's a bipartisan program. Actually, one of the few things where it's bipartisan, and a big reason for that is it's a zero subsidy program. So the fees involved in the program are what's paying it, that taxpayers are not paying it. That can change if there's higher defaults. That's my bigger concern as we push towards a more aggressive situation. Because like going back to the gurus selling the idea to people who are maybe underqualified, if a lender is willing to do the deal, and there's always a lender willing to do the deal, then the deal gets done. Because you have a buyer who doesn't know better, a lender trying to make a buck, and this is a big problem that has history tends to repeat itself. So if defaults spike and the program starts getting questioned in DC, that puts this whole thing at risk. That's probably a bigger risk than just them targeting SaaS on a one-off.
I like what you're saying there, just quantitatively. Hey, it's just not that high of a percentage even to be on a radar necessarily, or potentially at this point in time. But yeah, also I think that as times change the next 5 to 10 years, that percentage will obviously potentially increase. Regarding the subject of a spike in defaults, I haven't seen those data points. Have you seen any data points regarding defaults? And if so, are there any noticeable trends there? I'm trying to say, is there a spike in defaults with this guruism?
Nah, nothing you'd be able to see today. The default rate historically has been super low, like 1 to 2% in the last, going back to the Great Recession, where, during that period, it did go to double digits for a couple of the years. But, it's gone up. If you look at it from, year over year, it's gone up a lot. but 1.2 to 1.8%, like it's still low. So yeah, it's going up, but it's still really low.
Okay, that's interesting. Is it on a trend currently? Is it kind of doing this, or is it kind of going up presently?
I'm not sure.
No, that's fine if you don't know. I just think it's really interesting point that you raised.
But if you were
Yeah.
to speculate, do you see it potentially going up? You know, I heard one of the reasons why it's historically so low is because of the PG. So, you know, like the amount of like thought that goes into it and so on and so forth, just like, you know, it makes it more likely that the loans that people are taking out, you know, like are just more thoughtfully taken out. So what are you like, if you were to speculate on, you know, the trend, do you see the percentage increasing?
Well, that's yes, but you know what you just said is a big part of it. You know, all these loans are personally guaranteed, so you can't just, you know, turn back the keys and you know, walk away. You're at the table trying to figure it out if things get tough, and hopefully you can figure it out. I think a lot of the reason was you had historic low interest rates for, I mean, from 09 to 2015, rates were at zero. It was a 6-year period where rates were zero. Even going into COVID, the prime rate was only like 4.75%, I think. Yeah, that's right. So prime at when rates are zero, prime's 3.25. So they had only raised the rates. They actually raised them a little bit more, but brought them back down. So at the time COVID hit, which, you know, when COVID hit, Fed dropped the rates back to zero, but they were only a you know, $1.50 higher than 2009 when COVID hit. So they did not do any major interest rate raises that whole economic cycle. And so when COVID hit, they put them back down to zero. They flooded the markets with liquidity. And I mean, SBA was making your payments for you. They were making the payments for new people coming in. They were, I mean, it was just such a, you know, it was just like a fun time for people. Money was just flowing there for a while. And so you haven't really seen, so when there's money flowing like that, it's, you know, you don't go into default as much. There's more money available. So this is the first time we're starting to see that trajectory, and you know, that liquidity starting to run out. You know, that might mean taking on more expensive debt. That might mean credit cards for some people. So, you know, I'm not an economist, but you pay attention to those types of statistics to try to feel like, are people's savings going down? Is credit card debt going up? That's a leading economic indicator. And I do think next year the defaults will increase beyond what they are right now.
Side note question, unless Joe, there's anything you want to bring through here. Is there anything?
No, nothing particular. I think this is really insightful stuff. Go on.
Yeah, you're crushing it, Ray. Appreciate you. And so have you heard of, you know, these micro SaaS? Like, have you ever dealt with these? You know, micro SaaS is increasing in terms of, it's becoming a more popular area, you know, with platforms like acquire.com, for example, with, you know, the rising trend of no code platforms. I don't know if you've heard of these no code platforms. That are lowering the barrier to entry for, you know, non-technical people to be able to enter the marketplace. Have you like dealt with any of these like micro SaaS companies or any no code platforms or anything like that? I'm just curious.
No, but would these be like smaller transaction sizes? Like
Yeah, that's why I'm
100,000,
bringing it
50,000?
up. Yeah, because it's like, you know, they have that kind of that 5 million threshold. So it's actually perfect potentially for SBA funding.
Well, it's actually it's a well-timed trend, because I mean, me personally, like someone like me and historically, like BDOs that are in the space, BDOs, business development officer, so that's what you call someone like me. You work on larger deals because you kind of have that experience you bring to the table, and you know, it's just like you've got to draw the line somewhere in terms of a minimum loan. So mine's 500,000. but it's perfect because the SBA has been really pushing the small loan stuff. And we just set up a program for the small loans, and historically it just wasn't profitable for lenders to do because you've got to do the same amount of work, and obviously you're making less, and it was, the fees were expensive for borrowers, and all these different things that essentially the SBA has really been focusing on and doing a good job, quite frankly, of fixing, because they've, currently there's no fees for any loans. Right now it's, up to $1 million, but last year was up to 500,000. So there's no SBA fee. So I'm going to call a small loan 150 to 500. 150 under, we'll call express. That's always been there. 150 to 500, small loan. No fee now for borrower. The 500, it was 350, now it's 500. So they increased what a small loan means. They allow lenders to charge a little bit more on the rate, although I think most lenders are sticking with around prime plus 3, even though they could actually go to prime plus 4.5, I think it is. And then to top it all off, they've implemented a scoring model. So you can now score these loans, called an SBSS score. And then we also have other companies coming into the forefront to expand on that. And there's one called Lumos, and they provide a score as well that just allows lenders to have these tools to basically, instead of doing the full underwrite like we've been doing for years and years and years, score it and go. And so you can now get through these small loans more efficiently. And we're seeing a lot of smaller acquisitions run through that program now. And it sounds like those micro SaaS businesses might be perfect for it.
Yeah, and to your point too, I think with a lot of the micro, it's kind of interesting because micro acquire was a website, and then they rebranded to acquire, actually, because I think with, like I said, like a lot of these no code platforms, for example, especially with like the ridiculous multiples in SaaS, newer potential platforms might actually garner larger purchase prices that are still within that like 500,000 to 5 million threshold, as we see people just becoming more well versed in the market, and actually building viable like smaller SaaS businesses. Because the other side of the problem in the SaaS industry is if you raise too much money, you won't be able to exit. You have to IPO because it just doesn't make sense for your investors at a certain point. And so there's this like real sweet spot in the SaaS market where if you've only been working on this business for a year or 2 years, and your time, you can exit and walk away with, for example, $5 million, and you feel good about that because it's like some cash in your pocket for the last year that you've worked on this business and proven it out. There might be an opportunity there. Does anything come up for you here in that, or?
Well, our definitions of micro are a little different, I guess, because micro and SaaS, yeah, I guess that seems like that might be on the larger end of an SBA deal, $500,000 to 5 million. So I think the way I look at that would just be like any business. I don't, I'm not a SaaS expert, so I don't know. But if you're doing codeless SaaS, I would think, isn't the code a barrier to entry for someone to?
Yeah, that's something I talk about. Yeah, it is. It makes it easier for them to have competitors come in.
I'd actually, it's interesting that you bring that up, because I look at it, for sure, like code is absolutely important, but I don't think that ultimately, because it's the value of the IP for the most part, it oftentimes software, with patents, like kind of going in the legal direction, their software is like,
it depends on what the mode is, right?
That's what I'm talking about. Exactly. Like
typically though in software, modes are very frequently found in high expert development costs and the years needed to build that software.
I think that what we actually think moats are for scaling SaaS companies has less to do with the IP and more about connection to the audience. Because if you're stealing customers or you're capturing market share from, you know, the bigger players, they're, you know, that's where the bigger players are necessarily going to want to acquire you, for example. It's actually about.
Okay, I hear you there, but also, I mean, there's definitely a lot of things that I'd touch on there. It's like, well, a big allure of SaaS is the high margins. You don't get high margins when you have price pressure, when you have no code competitors readily coming. I'm not saying that it's necessarily the case that that's happening today. I definitely foresee, as we've discussed before, that happening in the midterm, 5 to 10 years, just people having a lot of price pressure from no code competitors. But so and that definitely plays within the 10-year time frame of a SaaS loan. But you know, this is nothing other than, you know, just a forethought.
I see a place for it though, because it's reminding me of the e-commerce space where, you know, people are, it's there, there's more stock in the brand and the revenue channels, and you could be selling anything. You could be selling a product, putting your packaging on it. That's what it is. You're selling a product, you're putting your packaging on it, you're branding it to a niche audience, and there's value in that. You know, I don't know how that impacts the multiples or the margins, but it reminds me of kind of where it's almost like it's 10 years behind the e-commerce space.
Yeah, it's an that's an interesting insight in terms of, yeah, like we saw the e-commerce space kind of blow up with drop shipping and so on and so forth, and we're actually kind of seeing SaaS go in that same direction, is what I'm hearing you identify.
Maybe I am a SaaS. I keep saying I'm not a SaaS expert. Maybe now I am. I don't know.
We're around the same age, and I think that there's just a lot that we're around in general that you probably pick up on anyways. Just kind of just being in our generation. I mean, there's a lot of these little trends, like, I mean, no code's definitely something more like specialist, but just kind of being aware of the markets and stuff. I mean, this is definitely the universe we live in now. I'm on something totally irrelevant. I was actually, I don't know, every time I think about it, I think, man, I feel like a teenager because TikTok Shop just opened yesterday.
Oh, really?
And I always associate TikTok with teenagers. I know that it's not just teenagers, but I don't know. That's just, you know, how
Are
I
you
feel
on
about
TikTok, Ray?
I was, and I put some videos up, and then but I recently deleted it because, you know, it just is a time suck.
For sure.
Oh, okay. Yeah, I mean, it's a whole thing, obviously, and but you know, so I mean, obviously, it's a big deal now. I've just made fun. You know, as a guy that's worked in the tech industry a lot, I'm allowed to make fun of things sometimes. So I always made fun of TikTok, but what I'm trying to say is the opposite of that is TikTok Shop just opened yesterday, and it's a huge deal, and it's going to kind of game change the e-commerce business. And not the SaaS in business per se.
I don't know, man. I'm skeptical about that because, like, everyone thought.
How could you be skeptical about that?
Everyone thought Instagram Shop was gonna crush it too, and like it hasn't delivered in the way that they thought that it would. Like, so why would you think that?
I just feel like TikTok's more willing to abuse and break boundaries on getting buyers with sellers, like they did with getting creators with their audiences, and TikTok's willing to kind of do whatever it takes from a code perspective to connect people, whereas you don't see the same thing from Instagram or Twitter/X. I don't know. They like to do shifty things. I know a guy in the tech industry whose friend who worked in marketing at TikTok, and yeah, there's the whole backstory there. That's kind of that conspiracy theory in the news, you know, about how they abuse data and stuff like that. I mean, that's definitely a real thing. I don't know. This is totally off topic, so I'm the guy to bring it off topic today. But it's like a really big deal. I actually think it's one of the bigger pieces of news in e-commerce this year. And I just wait a year or two. We'll see it. We'll see it be huge.
Yeah, let's take bets. Let's take bets. What do you think, Ray?
TikTok has proven to surprise us, you know, every step of the way. So I don't want to, you know, count them out.
Fair enough.
That's a conservative way to say it. Yeah, I agree with you on that. You know, but me having taken us off track here now, due to timing, I'm just kind of looking at the clock here and thinking about time.
No, I think like moving to close, Ray, really appreciate your time, man. Thanks for joining us
No, thank you guys.
on the show
Absolutely.
today. It's been a lot of fun. I know you've been on the podcast grind all day, so hopefully, we brought at least like a little. We try to make it fun, So
Yeah, no, I like the vibe.
But just to close out, we usually, you gave us a bunch of like insights, but I'd love to just get like a kind of like a sound bite, like a tip of the day. Do you have like a tip of the day for the audience or anything like that you can kind of just deliver in 1 to 2 sentences sort of thing?
Like a life tip or something
No.
that's relevant to what
You can
we're-
make it, honestly, if you want it to be a life
No.
tip, honestly, you could. Like...
Well, the point is acquisition tip. Life tips, hey, I'll take the life tip, but it's for the audience, so maybe an acquisition tip.
Sure. You want me to just go into it right now?
Yeah,
Okay.
just hit it.
I think the most important thing when you are going about an acquisition, especially your first one, is to surround yourself with experts. You need the right people in your corner to make you successful. That means a counsel, that means attorney, that means lender, and also talk to people who have done it before, gain their insights. And it's probably the best advice I can give anyone that's looking to embark on this journey.
Agree. Great tip. Yeah, Ray, thanks so much for joining us on SaaS Buyers Club today. Really appreciate you spending the time with us. I had a great time. And for everyone out there, I'm your host at SaaS Buyers Club, Omeed.
Yeah, and I'm your co-host, Joe.
And I'm Ray. And if you want to have more information about SBA financing, you can go to sbaray.com and you could check me out on LinkedIn and Twitter. And you could also go to my YouTube channel, SBA Ray, and I put out a lot of good information for people interested in using the SBA 7A loan program to start, grow, and acquire businesses. So check it out.
Awesome. Yeah, thanks everyone for joining us for another episode of SaaS Buyers Club. Make sure you smash that subscribe button, follow button, smash, and leave us comments. Reach out. We'd love to engage with our community. That's what we're doing here, is we're building a community. So thanks, and we'll see you next week.
Thanks, Ray. We appreciate your time.
Thanks for having me.